Beginner's Guide to Investing in Stocks. Investing in stocks is one of the most effective ways to build long-term wealth, yet it often feels intimidating to beginners. The world of trading platforms, financial jargon, and volatile markets can easily overwhelm new investors. However, with the right mindset, education, and strategy, anyone can start investing successfully. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. Understanding what stocks are. Before diving in, it's crucial to understand what a stock actually represents. A stock, also called a share or equity, is a unit of ownership in a company. When you buy a company's stock, you're purchasing a small piece of that company. If the company grows and becomes more valuable, so does your share. In simple terms, you become a partial owner of the business. Companies issue stocks to raise money for expansion, research, or paying off debts. Stocks are typically traded on exchanges such as the New York Stock Exchange, NYSE, or NASDAQ. Prices fluctuate daily due to factors like earnings reports, economic trends, and investor sentiment. As a beginner, grasping that stock prices are influenced by both company performance and market psychology helps you make rational decisions rather than emotional ones. The key takeaway: owning a stock means you're part of a company's story, its growth, challenges, and future success. Why you should invest in stocks. Many people wonder why they should invest in stocks instead of simply saving their money. The answer lies in the power of growth and compounding returns. While savings accounts provide safety, they rarely beat inflation. Stocks, on the other hand, have historically delivered higher long-term returns than other asset classes. Over decades, the stock market's average annual return has been around 7–10%, significantly outperforming bonds or savings. This means your wealth can grow exponentially if you start early and stay consistent. Investing in stocks also allows you to become a part of the global economy. As companies innovate, expand, and increase profits, shareholders benefit from that growth. Moreover, stock investing offers flexibility. You can invest small amounts, diversify your holdings, and reinvest dividends for compound growth. While short-term volatility can be nerve-wracking, history shows that patient investors who hold quality stocks tend to be rewarded over time. The earlier you start, the more time your money has to multiply. Simply put, stock investing isn't just about earning money. It's about building financial freedom and securing your future. How the stock market works. The stock market operates like a vast auction house where buyers and sellers trade shares of publicly listed companies. These trades happen on exchanges such as the NYSE, NASDAQ, or regional markets. When you buy a stock, you're essentially purchasing it from another investor who's selling. The price at which a stock trades is determined by supply and demand. If more people want to buy than sell, prices rise, and vice versa. This constant price fluctuation is what creates opportunities and risks for investors. Understanding how the market functions helps you see that it's not a casino but an ecosystem reflecting business performance and investor confidence. Stock prices are influenced by earnings reports, economic news, political events, and even global trends. Investors use two main methods to analyze stocks: fundamental analysis, evaluating company health, earnings, and growth potential, and technical analysis, studying price charts and patterns. The market can be unpredictable in the short term but tends to reward strong companies and disciplined investors over time. Once you understand this mechanism, investing becomes less about luck and more about strategy. Setting your financial goals. Before buying your first stock, it's important to define your investment goals. Ask yourself, why am I investing? Is it for retirement, building wealth, buying a home, or achieving financial independence? Your goals will shape your investment strategy, risk tolerance, and time horizon. For example, if you're investing for long-term growth, 10+ years, you can afford to take on more risk by holding growth-oriented stocks. However, if you're saving for a short-term goal, safer investments like index funds or blue-chip companies may be better. Assessing your risk tolerance. Every investor has a different comfort level when it comes to risk. Understanding your risk tolerance is crucial before choosing what to invest in. Some can tolerate large fluctuations in their portfolio value, while others prefer steady, predictable returns. Stocks, especially individual ones, can be volatile. Their prices can swing dramatically based on news, earnings, or market sentiment. If you panic and sell during every dip, stock investing might not be suitable unless you learn to manage your emotions. Building a diversified portfolio. Diversification is one of the golden rules of investing. It means spreading your money across different stocks, industries, and even countries to reduce risk. The idea is simple. Don't put all your eggs in one basket. If one stock performs poorly, others in your portfolio can offset the losses. For beginners, this is especially important because it protects you from the unpredictability of individual companies or sectors. Choosing the right investment platform. To start investing, you'll need to open an account with a brokerage platform. These online platforms let you buy and sell stocks, track your portfolio, and access research tools. Popular brokerages like Fidelity, Charles Schwab, Robinhood, and eToro offer different features for various types of investors. When choosing a platform, look for low fees, an easy-to-use interface, and educational resources for beginners. Researching and picking stocks. Selecting the right stocks is both an art and a science. Beginners should focus on companies they understand, businesses whose products or services they use regularly. Researching a stock involves studying its financial health, revenue growth, debt levels, and competitive position. Look at metrics like the price-to-earnings (P/E) ratio, earnings per share (EPS), and dividend yield. These indicators help you gauge whether a stock is fairly valued or overpriced. Developing a long-term mindset. One of the most important lessons in stock investing is patience. The market will always have ups and downs, but long-term investors who stay the course typically outperform those who try to time the market. Trying to predict short-term movements often leads to poor decisions driven by fear or greed. Instead, focus on your goals, maintain a disciplined strategy, and allow time and compounding to work their magic. Avoiding common beginner mistakes. Finally, avoid the pitfalls that trap many new investors. The most common mistake is letting emotions drive decisions, panic selling during crashes, or chasing hot stocks based on hype. Another is not doing enough research before investing. Always understand why you're buying a stock. Avoid putting all your money into one company or following unreliable online tips. Diversify, stay patient, and keep learning. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.